you haven't been able to raise revenues enough in a certain amount of time. That's the issue a lot of people are dealing with right now, is that they haven't had enough time to implement their plan. If it's a 3-year plan, you've only gotten a year into it. Your revenue is not going to be high enough. Plus, you're battling the markets. Yeah, so I'm basically in the trenches with this stuff like every day. I talk to my loan broker more than I talk to you, Michael. And it's interesting what's happening. So if you're first of all, if you're going for origination, you're going to be underwriting using agency, possibly bridge. If you're going bridge though, you're probably going to want to cap your interest rate exposure at a certain point. There's also a loan product that might pencil for a deal where it's like a fixed rate bridge loan where they're ripping off like 8.5%. And so you just have to make sure your deal works for that. So that's interesting on the origination side. We're seeing those. Nothing is great, but that's what we're seeing. And interest rates somewhere in the 6% range all the way up to 9-10% on the bridge loans. The refinance side, though, which is what a lot of people that already own properties are very interested in right now. If you try to do an agency refinance, you're probably not going to get out if you bought your deal in the last year and a half to 2 years. So that's the difficult part, is that the DSCR constraints make it difficult to get out of your existing short-term loan.
Okay, explain that real quick. So what is a DSCR, and then explain why those restraints are essentially what they're doing is they're reducing the loan to value, the loan proceeds you're getting, which means that when you refinance, it won't repay the previous loan. But why is that?
So it's because the interest rates have gone up. And so the same dollar that you're producing in NOI is less valuable, is essentially what it is, because your debt service coverage ratio is now at a different level than it was when interest rates were at 3.5%. If you're doubling it, that same dollar can only cover, because it's just basically your loan payments are so much higher, right? So your debt service coverage ratio, if it's a 1.25x, you need more dollars to be able to hit that 1.25x than previously, because interest rates were lower, the debt service payments were lower. Back then is how it works.
And so if your NOI is the same, but your interest rate has gone up and you still require 1.25 debt service coverage ratio.
Yep.
Then in other words, the only way that the bank will fix the difference if they can't raise NOI is to lower your proceeds.
Correct. Exactly. So you're getting loans at 50 to 65% typically. And on a refinance, it's more closer to probably 50% on a lot of these deals. Plus, you haven't had enough time to finish the project. So you haven't been able to raise revenues enough in a certain amount of time. That's the issue a lot of people are dealing with right now, is that they haven't had enough time to implement their plan. If it's a 3-year plan, you've only gotten a year into it. Your revenue is not going to be high enough. Plus, you're battling the markets at the same time on a refinance. So there is a product that we've discovered that has allowed us to get closer to that and take us out of some of these loans. And it's called a HUD loan, 223F. And these loans are very, the trade-off is you can get out of your loan. It's a high enough leverage point where you can get off, but they're fully amortizing and they're very difficult to obtain. It's full forensic analysis in your accounting. It's a whole process that's more arduous than going for an agency loan, and it takes 6 months to get it. So it's not for the faint of heart if you're trying to go after one of these. We actually are right now. But it can help you get out of the bridge loans that have a limited amount of time left on them. So that's something that operators I know are looking into, including us, to help us get out of some of these situations on some more recently purchased deals.
Yeah, that's right. So check out the HUD loan. Again, it's not for the faint of heart, but it's better than the alternative, which is bad. I mean, if you can't sell or you can't refinance, what are you going to do, right? So HUD loans is actually something that we're looking into right now, and there are some syndicators who in the past have done HUD loans. There are major advantages of them, but there's also a giant pain in the butt about them as well. But hey, beggars can't be choosers right now. So you guys look into the HUD loans if you're a current operator as well. And may be a great way to get out of any kind of floating rate debt that you have right now.